They'll tell you delinquencies are stabilizing. But in our poorest neighborhoods, the credit system is already failing people who pay for daily necessities with plastic. Let me be clear about what is happening. National credit card delinquency averages are hiding a class and geographic crisis. Low-income households are defaulting at accelerating rates, while high credit score borrowers drive record spending. The financial plumbing that profits from this split is designed to extract until it breaks. This is not a story about individual irresponsibility. This is a story about institutional design. The headlines in the second quarter of 2025 told a reassuring story. Credit card charge-offs fell to just over 4%, the third straight quarterly decline. National delinquency rates hovered around 3%, well within historical norms. The Federal Reserve's researchers noted that delinquency rates had flattened, reflecting slower borrowing and tighter lending standards. The message was clear. The consumer credit system is normalizing. The pandemic distortions are fading. Everything is under control. But charge-offs are lagging indicators. When a borrower stops paying, the account doesn't immediately become a charge-off. It sits in delinquency for months. The lender attempts collection. Legal recovery processes grind forward. Only 9 to 12 months later does the account get written off the books. So when charge-offs fall today, they are telling you about delinquencies from yesterday. They are a rear-view mirror, not a windshield. And if you look through the windshield, if you drill down past the national averages, you see something very different. The St. Louis Fed tracked credit card delinquency by zip code income decile. In the lowest income neighborhoods, 90-day delinquency rates climbed to around 20% by the first quarter of 2025. 20%. That is not a normalization. That is not a return to pre-pandemic stability. That is a localized collapse. These are people who are not buying luxuries on credit. They are buying groceries. They are covering rent. They are paying utility bills. And they are falling behind at rates we have not seen in over a decade. So who is spending and who is drowning? The answer reveals the fundamental bifurcation of the American consumer economy. Credit card purchase volumes hit all-time highs in the second quarter of 2025. All-time highs. The Philadelphia Fed's data on large bank credit card activity shows that this surge was driven overwhelmingly by high credit score borrowers. These are households with secure incomes, with savings buffers, with access to cheap credit. For them, the pandemic is over. Discretionary spending has rebounded. They are traveling, dining out, upgrading. They are using credit cards as convenient payment tools, paying off balances in full each month, collecting rewards points. But at the other end of the distribution, low-income households are using credit cards very differently. They are revolving balances. They are carrying debt month to month. The average card debt among borrowers with unpaid balances reached over $7,300 in the first quarter of 2025, up nearly 6% year over year. And they are paying interest rates above 22%. 22%. That is not the cost of capital. That is not a risk premium. That is extraction. Here is the interest rate trap. The Federal Reserve began cutting its policy rate in late 2025. The idea, in theory, is that lower policy rates reduce borrowing costs across the economy, giving indebted households some breathing room. But credit card APRs did not fall. they stayed above 20%. Why? Because card issuers pass through rate cuts slowly, if at all. When the Fed raises rates, card rates rise immediately. When the Fed cuts rates, card rates are sticky. The funding cost savings accrue to the issuer's profit margins, not to borrowers' monthly payments. So we have a two-tier monetary relief system. If you hold assets, if you have a mortgage, if you have access to capital markets, Fed rate cuts help you. If you are carrying credit card debt at 22%, you see nothing. You are on your own. How did we get here? The roots of this crisis lie in the pandemic credit cycle. During and immediately after the pandemic, lenders relaxed underwriting standards. Credit limits were raised. New cards were issued to borrowers who would not have qualified in earlier years. The logic was straightforward. Fiscal supports were flowing, household balance sheets looked healthy, and there was money to be made. Aggregate credit card debt expanded. More borrowers, higher balances, more interest income, more fee income. It was profitable. And it was predictable. But fiscal supports ended. Pandemic savings were drawn down. Real incomes for many households stagnated, even as inflation ate into purchasing power. And the borrowers, who had been extended credit during the boom, now faced higher costs of living and higher costs of borrowing. The Federal Reserve's own analysis attributes the rise in delinquencies to exactly this dynamic: higher borrowing during the pandemic, laxer underwriting standards, and then the withdrawal of support. Total household debt now stands at over $18.5 trillion. That is near a two-decade high. There is no cushion left. And then came the student loan reporting shock. During the pandemic, federal student loan payments were paused. Borrowers in default were not reported to credit bureaus. When forbearance ended in 2024 and 2025, those past due payments were suddenly re-reported. Millions of accounts that had been invisible on credit files reappeared as delinquent. This was a mechanical change, a bookkeeping adjustment, but it had real consequences. Credit scores fell. Access to other forms of credit tightened. Households that were already stretched found themselves facing higher borrowing costs or outright denial. A reporting change turned into a balance sheet shock, and that shock rippled through the entire consumer credit system. The crisis is not evenly distributed. It is geographic and it is social. State-level data show sharp variation in delinquency rates. Some states have credit card delinquency rates well below the national average. Others are significantly above. Within states, the variation by zip code is even starker. The St. Louis Fed's work makes this clear. Delinquency is concentrated in low-income communities. National averages smooth over this concentration. They tell you that the system as a whole is stable. But the system as a whole is not a meaningful unit of analysis when 20% of borrowers in the poorest neighborhoods are in serious delinquency. The map tells the truth that the average hides. This is not the first time we have seen this pattern. Before 2008, subprime mortgage lenders expanded credit to borrowers who could not afford it. They charged high fees and high interest rates. They securitized the loans and sold them to investors. They profited handsomely. And when defaults rose, the losses were socialized. Taxpayers bailed out the banks. Borrowers lost their homes. The playbook today is structurally similar. Expand credit to vulnerable households. Charge them interest rates that would have been illegal under usury laws a generation ago. Securitize the debt. Profit from origination fees and interest income. And when defaults rise, shrug and say that borrowers were irresponsible. Who profits from this system and who makes the rules? Credit card issuers, non-bank fintech lenders, and the securitization markets profit from fee income and high APRs. They have lobbied successfully to keep federal usury caps off the table. The regulatory environment is light touch by design. The Federal Reserve sets monetary policy, but it does not cap credit card interest rates. The Consumer Financial Protection Bureau has some authority, but it is under constant political attack and its powers are limited. The result is a system in which the rules are written by and for the creditors. Losses concentrate among low-income borrowers. Profits concentrate among issuers and investors. This is not a market failure. This is a market working exactly as designed. And there is a plumbing risk that mainstream coverage consistently underplays. Credit card debt is securitized. Pools of card receivables are packaged into asset-backed securities and sold to investors. When delinquencies rise, the performance of those securities deteriorates. Spreads widen. Funding costs for issuers increase. If losses spike, the securitization market can tighten sharply, cutting off credit supply and forcing further contraction. Regional banks that hold significant card portfolios on their balance sheets face rising charge-offs. Their capital ratios come under pressure. This is not a hypothetical doom loop. It is a transmission mechanism that we have seen operate before. Household credit stress does not stay contained in household balance sheets. It propagates through the financial system. Now let me steelman the counter-argument, because it deserves to be taken seriously. Federal Reserve researchers argue that delinquency rates have flattened into the third quarter of 2025. They point to slower borrowing growth and tighter lending standards as evidence that the system is self-correcting. They note that national delinquency rates at around 3% are within historical norms, not at crisis levels. Charge-offs are declining. The worst may be behind us. This is a return to normalcy, not the beginning of a collapse. But this argument rests on three flawed premises. First, it treats national averages as if they were meaningful measures of systemic health. They are not. A 3% national delinquency rate is cold comfort to the household in a low-income zip code where 1 in 5 neighbors is seriously delinquent. Averages obscure distribution. And in a highly unequal economy, distribution is everything. Second, the argument ignores lag dynamics. Charge-offs are declining now because they reflect delinquencies from 9 to 12 months ago. If delinquencies re-accelerate, and there is evidence in the lowest income deciles that they are not flattening at all, then charge-offs will follow with a lag. The current decline may be a temporary artifact of timing, not a signal of recovery. Third, and most fundamentally, the argument accepts as normal a system in which millions of people pay 22% interest to buy food. Even if delinquency rates stabilize at pre-pandemic levels, that does not make the system just. it does not make it sustainable. It makes it extractive. A system that charges usurious rates to the poor, that profits from their desperation, that socializes losses when the model breaks, is not a system that has normalized. It is a system that has been normalized. There is a difference. So what does this mean? The US consumer spending engine has not broken uniformly. It has bifurcated. There is a high credit score tier that is spending at record levels, that is driving economic growth, that is doing fine. And there is a low-income, debt-trapped tier that is falling behind, that is defaulting at accelerating rates, that is already in crisis. This bifurcation is not an accident. It is the design. Extract maximum revenue from those who can pay. Extract maximum fees and interest from those who cannot, until they default. Then write off the losses, tighten standards for a quarter or two, and start the cycle again. The headline stabilization is a mirage. It hides a class and geographic crisis that is already underway. What should you watch? Watch 90-day delinquencies in low-income zip codes. If they continue to rise, the charge-off wave will follow. Watch regional bank charge-off rates. Small and mid-sized banks are more exposed to consumer credit risk than the largest institutions. Watch spreads on asset-backed securities backed by credit card receivables. Widening spreads signal that investors are pricing in higher expected losses. And watch whether Federal Reserve rate cuts actually pass through to credit card APRs. If they do not, if issuers pocket the savings, then monetary policy is not reaching the households that need relief most. What should you demand? Demand federal usury caps on credit cards. There is no economic justification for 22% interest rates on consumer credit. Demand automatic pass-through of Federal Reserve rate cuts to card APRs. If the Fed cuts rates to stimulate the economy, that stimulus should reach indebted households, not just asset holders. Demand debt relief for student loan and credit card borrowers. The reporting shock and the interest rate trap have created a debt overhang that millions of households cannot escape through their own efforts. And demand public credit options. If private lenders will not provide affordable credit to working people, then public institutions should. Postal banking, public development banks, credit unions with public backing, these are not radical ideas. They are how most of the developed world ensures that credit is a public utility, not a profit center. The question is not whether defaults will rise. The question is whether we will act before the next wave, or whether we will wait until the financial plumbing breaks, and then, once again, socialize the losses while privatizing the profits. A credit system that charges 22% interest to people buying food is not a market. It is a tribute system, and the tribute is now unpaid. So here is my question for you. When the next wave of defaults hits, and it will you accept the narrative that borrowers were reckless, that they lived beyond their means, that they should have known better? Or will you ask, who designed the system that profits from their desperation, that charges them usurious rates, that traps them in debt, and that then blames them when they cannot pay? Because the answer to that question will determine whether we repeat this cycle or whether we finally break it.